All right, so in this video, I'm going to talk a little bit about a few different measures of cash flow. So to start off, in order to get to our first measure of cash flow, we need to go back to EBIT, which I discussed briefly in a prior video. But EBIT stands for earnings before interest and taxes. So if I start off on the income statement, I go to sales minus cost of goods sold to get to gross profit minus various operating expenses to get down to earnings before interest and taxes, which is also called operating income. Then I take off the interest to get to earnings before taxes. Then I take off taxes to get down to earnings, which is net income. So EBIT is kind of partway down the income statement, and it's basically derived from our operations, hence why it's often called operating income. So I'm going to take my earnings before interest and taxes, and then I'm going to use that to calculate NOPAT, net operating profit after tax. And the way I'm going to calculate that is I'm going to take my EBIT times 1 minus the tax rate. So T stands for the tax rate here. Okay, so this is the tax rate. So 1 minus T, which is the tax rate. And that gives me my NOPAT, which stands for net operating profit after tax. And basically what we're doing is we are trying to do a more fair comparison or more fair assessment of what's happening in terms of cash flow based on a firm's operations. Because once I get below the EBIT level, it's earnings before interest and taxes, I'm going to start taking out interest, which is essentially related to a financing choice of the firm. It's not an operating choice. Now they're obviously related, very much linked, but technically how I pay for the firm is a bit different from what's happening in terms of operations. So if we're trying to look at operating cash flow, we're trying to focus in on the operations, hence why we start with the operating income. But we know, there are only, to borrow from, I believe it was Benjamin Franklin, there are only two things certain in life, death and taxes. So we're going to have to pay taxes. So we essentially act as though we're paying taxes on the EBIT. And so that's where this 1 minus T is coming from. So if the tax rate was 20%, 1 minus 0.2 would be 80%, basically saying I take 80% of my operating income, and that's going to give me my net operating profit after tax. This is essentially what I would have as a profit for a business if I had no interest and no unusual items on my income statement. That's basically the profit I would have had. But then once I have my NOPAT, to get to my operating cash flow, we're going to add back depreciation. And so the reason we're adding back depreciation is because depreciation was an expense that I was showing up here before I got to the EBIT, because that was part of those operating expenses, but it was non-cash. So I'm adding it back to reflect the fact that I didn't actually spend any cash on it. And so I take my NOPAT plus the depreciation, that gets me to my operating cash flow. And so if you're making plans going forward, one of the things you'd want to look at is, what's happening to my operating cash flow, or what are we expecting to have happen to my operating cash flow? And how will that then relate to my plans, my ability to pay for expansions or new products, or et cetera. Now, a related concept is free cash flow. So free cash flow is the cash flow that's available to investors. So if I'm making plans, one of the things that we want to look at would be, well, given my plan, what do I expect to have occur with my free cash flow, the cash that I could actually offer to my investors? Now, in this case, investors is used broadly. So this would include shareholders and also lenders. So what's happening to the cash flow that would be available for me to pay those entities? Well, to find that, I'm going to take the operating cash flow figure, but then I'm going to make more adjustments. And so I have these two subtractions here, minus this NFAI and minus this NCAI. So this NFAI is the basically going to be the net fixed asset increase. And then this NCAI is the net current asset increase. And so basically what's happening here is I have a certain amount of operating cash flow, but some of that operating cash flow I may have then plowed back into the business in the form of purchasing more fixed assets or purchasing more current assets. So if I had a net increase in net fixed assets, so if I had an increase in net fixed assets, and basically that took some of my operating cash flow. So I'm going to take my operating cash flow minus what I plowed back into the business in the form of the fixed assets. And then I'm also going to subtract off what I plowed back in the business in the form of basically current assets and things like that. Now I'm going to add a little bit more detail to this in a minute. But basically what we're looking at is I got some cash from my operations, the operating cash flow. But some of that I needed probably to spend on just sort of maintaining my business and plowing money back into fixed assets and things like that. So if we back up for a minute, I added back depreciation because it was non-cash. But the idea behind depreciation was it was trying to capture that my machinery is wearing out. And we know, just from reality, my machinery is wearing out. So if my machinery is wearing out, I am going to have to put more money into things like my machinery because my machines are wearing out every year. So with my free cash flow, this is what's available to investors. To get to that, what I have to do is take my operating cash flow and then account for the fact some of that money had to be spent on basically fixing up my machinery, buying new machinery, things like that, just so that I can do this again next year. And then once I've done that, now we're getting closer to money that is available that I could send to investors. Okay. So let's talk about the NFAI and NCAI. So to find my NFAI, basically what we're going to look at is the change in net fixed assets. So from the prior year to the most recent year, what's happening here? Or if I'm forecasting this from the most recent year to my projected year, what's the change that I'm expecting here? So my change in net fixed assets plus whatever my depreciation expense figure was. And that's going to help me figure out, essentially what's the total amount that as a business I poured into net fixed assets. And then that's my NFAI figure that I would then subtract from the operating cash flow. For my NCAI, I'm going to find the change in current assets, but then I also am going to subtract off a change in accounts payable and accruals. So this one's a little bit more nuanced. So here's kind of what's happening. So if, for instance, my business is growing or I'm pouring more money into inventories or things like that. So if I poured a whole bunch more money in inventories, then I'm going to have this big increase, this big change in current assets here. However, if I bought all those inventories on account, then technically I haven't spent my cash yet on it. So I'm going to subtract off the change in like accounts payable to reflect the fact that my inventories went up, which would make me think, oh, cash went out the door. But if accounts payable went up, well, maybe not really, because I bought it on account. I haven't paid for it yet. So in that case, I could have a situation where that NCAI may not actually be very significant at all. Even though the inventories went up, the accounts payable basically are how I paid for it. So that's why we're subtracting off the change in accounts payable and also accruals, because I could have certain current liabilities that change. And as those current liabilities change, that could be where the money is coming from that is being used to pay for the current assets, not my actual cash. So we're trying to separate out, how much of my operating cash flow was going towards basically the change in these current assets and not. So once I've calculated out my NCAI, okay, so basically once I've looked at that, then and my NFAI, so once I have that, so my net fixed asset investment, net current asset investment. So basically, what did I do net for those? So then I would take my operating cash flow minus those two to get to my free cash flow. And whatever my free cash flow is, that's basically what is going to be available for me to pay out to shareholders. And if I'm doing this from a planning standpoint, if I'm projecting some of this out, I want to kind of hopefully in the long run see that I'm gradually generating more free cash flow. But over a particular year, if I had to buy a bunch of fixed assets, a lot of my operating cash flow might get used up by that change in the net fixed assets, and that may be okay. But you want to look at that bigger picture of hopefully we're getting better, we're getting more money available for my investors overall in the long run when you're assessing them. Okay, hopefully this video has been helpful and hopefully it makes sense. Thank you so much for watching and have a great day.